What we're seeing now is that historically developed market investors think of geopolitical risk as a emerging market problem. When we talk about geopolitical risk, we're really talking about emerging markets. I think geopolitical risk is coming to our markets, and I think it's coming to Europe, and I think it's coming to North America as well. So social dissatisfaction, social fracture, I think are the long-term risks that we face, as well as what happens when we unwind this great experiment that we're conducting through central banks. So two things you can do there. First, be mindful. And I think being mindful is the best hedge you can have, i.e. don't get yourself over your skis by being involved in the levered long trade that everyone else is involved in. And then the second is just some really, really simple trades like you had on prior to the crisis. And I think with negative yields on the Bund at 10 years, there's a short for you. It's a short that's cost a lot of people for the last few years, but you're supposed to go and hedge through those instruments. And then the second really big hedge is to be short the stuff that everyone else is levered long. And it doesn't take a rocket scientist to know that the super liquid stuff is where everyone is levered long. So we favor some of the more complex, less liquid instruments over some of the super liquid, less complex instruments. And that's the way our portfolio will be constructed for the next few years, I imagine.